You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so it is the season. Today we are going to talk about a strategy that exists that is a very festive strategy. That strategy is called a Christmas tree butterfly. Now, if you will, I'm going to take an old family recipe. I'm going to mix it up into that little butterfly. And we're going to try to figure out a way to do this Christmas tree butterfly for a net credit to the account. Now, it's not going to necessarily, it's going to lean a little bit when we get done with our Christmas tree. Maybe we call it a Charlie Brown Christmas tree, to coin a phrase. But in general, we're going to do a very festive strategy. And yes, I did pick this strategy out because Christmas is not that far away. But before we get there, I want to talk about Roku. We looked at Roku last week, and as far as the paper trades that we have had on long straddles overall, they've done pretty well, to be blunt. Bottom line is the underlyings that we have picked have been very volatile over the time period, and the market in general has been more volatile than the marketplace has anticipated. In other words, the actual volatility of the marketplace over the last couple of months is higher than the implied volatility was. Now, you'd be looking at that on whatever index you'd look at, like basically a 30-day historical versus a 30-day implied. But in general, this has been the case. So we thought we would do a rinse and repeat. I talked last week about Roku. It was one of the stocks that we had done a long straddle on. Now, volatility is fairly high in that underlying just in general, but we're saying that over time it's actually been more volatile than what the marketplace was implying. So we went in, and the date we taped Options Playbook Radio on a Wednesday. The market was closed. The date was December 4th, and today we're taping Options Playbook Radio on a Wednesday. The markets are closed. It's December 11th. So I told you I'd follow up on it. So today I just went in and I pulled a quote on it. Since we did the trade, we haven't had a huge amount of volatility in the underlying stock. Honestly, the stock has settled down just a little bit. I don't know why I wouldn't be honest, but in general, the stock has settled down just a little bit. It's December. That was on December 4th. The stock was trading at, well, the market was closed, but the stock was at 150.58. It was up $6 on that day. And since that time, the stock is now down $5. But the problem is that we actually saw the long straddle, the 150 buying the 150 call and the 150 put was trading for about $16.25. Now, we did say this on the call. that we would go out and try to sell some premium in Roku, as long as we could get something and we went out and made the spread wider than what the total cost of the long straddle was. So we looked at selling 20 points higher on the December 13 expiration, the expiration that was 1 week before our expiration date. So we sold the 170 call, and then on the put side we sold the 130 put. That means it's 20 points wide in either direction. December 13 expiration, that was about 7 days away, I guess. What is the date today? 11th? I guess it was a few more, because of Friday, right? So it was 9 days away. And that was selling for $2. So net, the entire cost of the straddle was $14.65. Now, we talked in detail last week about the fact that if you did this straddle, it's very hard to lose the entire amount that you pay for it. Now, we brought in some premium, gave us a little bit of time, but we were wide enough on our spreads that was worth $20 if it actually moved to the higher call strike at 170 or to the lower put strike at 130. The max potential of that spread, of either of those spreads, was $20. So why not do this just in case, just as a little buffer in case we didn't get the type of move that we were looking for? And honestly, in the last 6 or 7 trades that we've done long straddles on, the market has made enough move to easily cover the price of the straddle and then some. But in this instance, the market did not. So I think that this is a great learning experience in that we did a long straddle and it did not pan out. We got a 5-point move in one direction, and it's it has done nothing but gone down by looking at the chart. It hasn't really gone up. It's gone down a little bit more, bounced back a little bit. But we're at 145, 5 points below where the stock was at when we put this trade on. And we see that our December 20th 150 long straddle is now trading for $11.50. We paid $16.25 for it, but remember, we sold 2 out-of-the-money option contracts, brought in $2. Now, you might say, well, what are those option contracts trading for? And the answer is the 130 put is trading for about 15 cents at the midpoint, and the 170 call is trading for 3 cents. So, if you were to close out that, it would cost you 18 cents. So overall, we made the money from the out-of-the-money call options. If you just close it out, period, we paid $2 for it. We could just go back in. We could buy that back for, let's call it 20 cents. You'd make $1.80 on it, and that would offset your risk. So now the question becomes, we did this trade. Are we going to get out at this point in time? And that's the bigger question overall. How much longer are you willing to wait to see if this underlying stock will make either continue on down and go down another 10 points, or bounce back and maybe go up 15 points, because that's really what we need, 15 or 20 points to the upside. And I think I would give it a couple of days. Honestly, if I look at this trade, I know that we have a December 13th expiration. We know that there's 2 more days to go. We could get another 20 cents in credit on our short strangle that we did. Instead of buying that back, why don't we just let that ride, and we'll see where we end up at the end of the week. I would give myself until Monday on this trade, but on Monday, if the stock has not made a significant move, I'd look to get out of it, salvage what you could on it. But it's good to know that we put this thing on for $16.25. We were looking for a 15-point move in either direction. We got a 5-point move in the down direction. And we ended up, we could sell it right now at the midpoint, if we could get the midpoint, for $11.50. And the total cost of our trade was $14.25 when we look at the whole gaggle of securities that we put on. So if you think $14.25 and you subtract out $11.50 on the entire trade, we're down $2.75, and I think that is a fairly decent get-out point. I would wait till Monday, though, and I would look at it, and we'll see where the stock is at on Monday. We'll look at that on our next week's Option Playbook Radio. And let's get to our trade this week. So interesting to see how it happened. It made a little bit of a move, but not quite the follow through on volatility. So the ones that we can learn on are best in Options Playbook Radio. Everything that we do here is only meant for learning. Nothing's meant to be a recommendation. So it's great to have some trades that work out like this, so you can just see how the pricing is and see how time decay has happened on our long straddle, and just work through the whole math and see the final. If I'm wrong on this trade, what is the true risk of our long straddle that we put on? Okay. So, Christmas tree butterflies. Well, today, since we're just going to do a fun and festive trade, I don't think we've done many Christmas tree butterflies. So if you look inside the Options Playbook, it's actually, we're going to use call options. We're going to be a little bit bullish. Might as well be positive going into the holiday season. And we see the Christmas tree butterfly inside the playbook is on page 118. Now, we're going to modify that trade. If you look on the Christmas tree butterfly with calls inside the Options Playbook, what you're looking to do here, and I'm not quite sure where the name came from, Christmas tree, it doesn't make a ton of sense to me why they came up with it, but it is the name of the strategy. You buy a call at strike A, you would skip strike B, you'd sell 2 calls at strike C, and then you would buy a call at strike D. In other words, I am doing let's say inside the S&P 500 index, let's use that today, the long spread of our Christmas tree would be 10 points wide. The short spread in our Christmas tree would be 5 points wide. So in order to make this a butterfly where you have limited and known risk and your maximum peak is at the middle, we end up doing 2 of the short spreads to lower the cost of the long spread. All right? So the ratio here is strike A, we buy 1. Strike C, the one that we're selling, we sell 3. And strike D, we buy 2. All right. I'm going to adjust this. And we're going to still have this butterfly, but I'm going to throw another credit spread in on it. And then we get this done for a net credit. And honestly, this is an alternative to just selling a credit spread. So let's start by looking at the credit spread, and then let's talk about, yes, we add complexity to the trade, but then let's talk about what this trade actually does by turning it into, and I'm just going to coin the phrase, a Charlie Brown type Christmas tree, a one that's very slanted, that's about ready to fall over. Okay, so if I was thinking about doing a short call credit spread, we have the S&P 500 index right now trading at $3,141.63. A very viable short call credit spread with a market, let's say we'll just talk about the at-the-money strike being 3,140 or 3140 if you want to say it short-handedly. That is the most at-the-money option contract. It's a little bit in the money on the calls. The expected move for this expiration, which is only 2 days away, if you look at buying the long call and buying the long put, is about 20 points in this instance, right on the midpoint. So we're going to use that. And if I were to sell a credit spread on this index, oh, by the way, the Fed just announced today the volatility is up around 15%. And that's part of the reason why I would look to do this trade is because vol is fairly medium. It's not down at 10 on the VIX index. It's not at 12. It's 15. So there's still a little bit of juice in these option contracts. I would go 20 points out, and I would look to sell basically the 160 call and buy the 170 call. Now, that's a 10-point wide spread. I could get that done for $2. That's a very viable option. But what I'm going to do here is I'm going to adjust this. And we're going to use option prices to do this trade. But instead of selling that spread, we're going to put on our quote-unquote Charlie Brown Christmas tree. And we're going to go out, and I'll just give you the strikes, and let's set this up, and let's then go back and look at how we adjusted it. our goal is that we want to bring in a viable credit. If we sold the 3160, bought the 3170, we would bring in a net credit of $2 with a 10-point wide spread. That means we would have 8 points worth of risk. So now, if we buy the 3160, sell the 3170, and then buy the 3180, all right, if we did that 1 by 2 by 1, that would be a standard butterfly. That would just be a normal butterfly. You'd buy one of the 3160s, you would sell 2 of the 3170s, and you would buy 1 of the 3180s. So now our goal here is we want to sell enough credit spreads to pay for the butterfly. Okay, so how do we do that? Here's the ratio that we're looking at. We're going to keep the same strikes. We are once again going to buy the 3160 call, December 30th expiration. We have 2 full days of trading. You'd have all day Thursday, all day Friday before these options would expire. And then we would sell 4 of the 3170s. And then we would buy 3 of the 3180s. Now, the key to this scenario here is that the bought legs add up to the short legs. So we bought 1 3160, so bought 3 3180s. That means there's 4 contracts. So guess what? We sold 4 of the 3170s. It adds additional risk, but it's not any more risk than if we were selling the short spread. But in this scenario, if the market does run up to the 3160 level, guess what? We still got a butterfly embedded inside this credit spread scenario. All right, so if you were to look at a profit and loss graph, you still have the risk of the fact that we're selling a couple extra credit spreads to try to pay for this. But if we look at the mid price of this trade, we can get this done for $8 credit. We were trying to get this done for a $2 credit, and we were going to be a little bit closer to where the underlying stock is. So we'll take a buck in this scenario, and our overall risk of the trade here is now going to be $2,000. But we got this little benefit that if the market starts running up, and we only have 2 days away to expiration here, at expiration, if this position finishes right at our short strike, 3170, on the upside, we can make another $1,000. So, what's the risk reward here? If we do this trade, we increase our risk by another $1,000. We sell a couple credit spreads to try to pay for our butterfly. We bring a net credit of $1 into the account. The market goes down, we make that $1. That $1 is ours. It would be, in this instance, $1.05 if we could fill at the midpoint. If the market trickles on up and eventually closes right at the 3170 level, or just below it, or somewhere in that range, we are long a spread from 3160 to 3170. So any of that is a benefit to us. All right? Any of that is a benefit to us. So it's just an interesting alternative. If you're thinking about doing a credit spread, you're thinking about bringing in some risk by doing that type of trade, why not think about doing this trade? Yes, you do double up your risk. You're going to do 2 credit spreads to help pay for the butterfly. But it's an interesting scenario. If the market goes down, you make a buck. If it comes up, you can actually make more than you would have, obviously, if you just did the short call spread. And you have a chance to basically hit a home run where anywhere you can land. And if it lands anywhere between 3160 and 3170, you get the benefit of being in an index that you could either close that trade out or it's a cash-settled index. You just let everything ride. So with all that said, I would only do this like in an index, something where I don't expect a gap opening like a stock would. Like a ROKU would not be a underlying that I would want to do this in at all. So I'd want to do it in an index. You want something that is a higher price index, which the S&P 500 index is. Obviously, at a 3140 is approximately where the index is at, 3,140. And the reason why we're looking at that, or why we want a more expensive index, is that means there's just a lot of time premium in it. And so in order to do this trade and get it done for a decent net credit into the account, you need a fairly valuable underlying. And then we want to do it short term, because why? We want all that time decay to go away real quickly. And in the SPX, with the last 2 days, you get a ton of time decay. So that's the reason why we're doing it. We don't want to go out another week. If we go out another week, you actually have a lot more risk that that the stock could open and go through your strike and not allow you to get out and try to get a profit on this trade. So if we do this trade and the market opened down tomorrow, that's great. It doesn't hurt us at all. If the market does open up, we want it to drift up slowly. We don't want it to fly up towards our butterfly or our Charlie Brown Christmas tree butterfly in this scenario. Now, if you want to look at a profit and loss graph, this is a very interesting profit and loss graph to look at expiration and as of today. But let's recap the trade. We're taping Options Playbook Radio on Wednesday, December 11th. The markets are closed. We're going to use the December 13th expiration. That means you have 2 full days of trading in the S&P 500 index options, all day Thursday, all day Friday. These are considered the weeklies in the S&P 500 index. We're going to be buying 1 of the December 13th expiration, 3160 call. We're going to sell 4 of the 3170 calls, and we're going to buy 3 of the 3180 calls. The expected move on the underlying is about 20 points. So to get all the way up to our short strike, we're looking at about a 30-point move to get there. And we hope that it just goes a little bit shy and it doesn't make much more than that move at all. Our risk is really from 3170 all the way down to 3180. Our max loss is 3180 or above. We're bringing in a net credit of $1 to the account. So if we're dead wrong and the market goes down, we make that net credit. If we are incorrect and the market goes up and goes above 3180 and we don't get out of the trade, first of all, we get the stupid award for not getting out when it hit 3170. But to go along with that, our max risk would be we have 2 short spreads that are paying for our butterfly here. So that's $2,000 minus the $100 brought in. That's $1,900 on this scenario. And that's it for this episode of Options Playbook Radio. I hope that this is festive leading into the holidays. We'll look at this trade next week. We got a couple more episodes, but then we'll probably be closing down for the holidays. So make sure you sign up and click subscribe and listen to so that you get all the reminders for next week's podcast that is coming out. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.